Here we
Hey,
go.
good morning, everyone, and welcome to our second webinar in our Portfolio Analysis Mastermind. So before we jump into it, gotta give you a disclaimer that this is for illustrative and educational purposes only. We are not CPAs, we're not lawyers, we're not financial planners. So always make sure you talk with your professional team to figure out what is best for you and your financial portfolio. So my name is, the goal of Portfolio Analysis Mastermind is to have you walk away with a clear understanding of your portfolio. And we are doing that via a mastermind format. And it's a mastermind of the audience, the people watching and participating with us. We like getting your feedback, but also from our panel here as well to pick their brains and get their perspectives. So last week, I led the presentation with going through my portfolio. And this week we have Jenny Bayless doing a segment and then Lon Welsh doing a segment as well. So it's going to be great to see how they analyze properties and we can ask them questions and also pick their brains. All right, so to give us the official introductions, my name is Chris Lopez there. One of my co-hosts is Lon Welsh with Iron Capital. Good morning, Lon.
Good to be here.
Last but not least, well, got a couple coming in there. Jenny Bayless with Envision Advisors. Jenny, how are you?
I'm doing great. Good morning.
And then Travis, who I think I screwed up on the PowerPoint animations there, but Travis Spear with Renovo.
We came in together. So
yeah.
Hey, Chris.
Glad to have you on here.
Thank you.
And then Aaron Clinkscales, who is our portfolio analysis specialist, and he's joining us remote. What's up, Aaron?
Hey, how's it going, guys?
Really good. So we're going to just jump into a bunch of things here. And as we go through some housekeeping, I want you guys listening and watching ask questions. Like last week, we had a bunch of questions and comments. It was great. Please keep those coming. We enjoyed it. It also helps us do a better job of explaining the topics here. And I've seen the slides we have. They are some meaty topics. Do not be shy with questions. And we have our webinars coming up. So we did the first one. And make sure you come out to the other ones. This is week number 2. And plug into our resources page on Notion. There's a QR code for with all the recordings, the slide decks, anything that we reference throughout the podcast will be there. And we have our private Facebook group. And then most importantly, have all the resources we have. Make sure you go in and create your Property Llama account. Scan the QR code or go to propertyllama.com. Go create your account. Because that is going to be the dashboard, help you analyze and track how your current portfolio is doing. And then what we're going to be offering next week, starting on the next Tuesday call, myself, Jenny, and Aaron are doing a lot of work to actually streamline doing a portfolio analysis review. And so our goal is to offer a free 30-minute session with everyone that wants to come through and have one. We do have some requirements. One being that you put your properties in Property Llama and do some prep work because they're very dense calls and we want to make them very effective. So next week we'll have a link and a QR code so you can go out there and register for a free 30-minute one, and we'll go through your portfolio, help you figure out opportunities, and take a lot of stuff that we're talking on the webinars and help you apply it to your portfolio. So be on the lookout for that next week after Thanksgiving. Now, to jump into the fun stuff, we got Jenny doing the first one, and I'm going to hand Jenny the keyboard. And everyone out there, ask questions, panel, Aaron, Lon, Travis. I'm going to put you guys in the hot seat as well. Give your comments, ask your questions as well.
Yeah, I'm excited. So this is, we're just going to call them Investor One, a very typical profile that we see from our clients. They have quite a bit of equity in their Denver home, and they have one rental property that was formerly their primary residence. They turned it into a rental, and that one has a lot of equity in it as well. So again, we're going over our 5-step portfolio architecture action plan. We'll do it step by step. So first one, review and align goals. So they have 2 main goals right here. Oops. They're in their accumulation phase, and their goal is to have $2 million in investment real estate. So I really like this person's goals because they have a very clear and defined goal. It can adjust as she progresses throughout her investment career, but I like that she's very specific on this. And she is open to utilizing her primary home's equity that's in it And she's also interested in active and passive investments. So very open to, using everything that she can to meet this goal. So going into her holdings, she has one condo, former primary residence, that is currently an active rental. She has her primary residence, not treated as a rental, but treated as an equity piggy bank, and no passive real estate yet, but open to it. So just going into her current holdings, this is her active real estate. So really the key points we have highlighted here. So this is her investment condo. She has about $400,000 in equity, very low loan to value, 34%, and it's currently operating at a 3.8 cap. So I know we talked about this in different sessions, but it falls below that kind of 4% cap rate trigger that we want to take a further look into. And key point is that this investor, she bought it in 2005, but let's use current numbers. We want to see what it's doing today. So it might have been a great rental property originally, but what about now after it's experienced massive appreciation? Okay, and then this is her primary home. Again, it's not part of her investment portfolio, but she is open to using it as an equity bank for her. So she has about $300,000 in equity on her primary. She currently has, 2.875% 30-year fixed mortgage.
Don't mess with that.
Yeah, don't mess with that. Yep, exactly. And then nothing yet in her passive portfolio. All right, so now we're going to go to step 3, which is analyzing the individual investments. So since she has one investment property, I think we can spend quite a bit of time on this one in particular. So what I did for this individual investor is we're going to model out what a 1031 exchange would look like for her. So she's going to trade up into a bigger and better performing property. So again, she bought it in 2005, refinanced it about 3 years ago at a 15-year fixed at 3%. So amazing interest rate, especially for a rental property. And I know that can be a hiccup for a lot of people now that we're in a rising interest rate environment. But I just wanted to show kind of how she's able to catapult towards her goals faster by still looking at this as an option. So what we did here is we used the modeling option within Property Llama. And so what I did was I took her equity, which again was about $400,000, took out some selling costs, and I leveraged it at a 65% LTV.
Why 65%?
65% is because that's kind of what we have decided as a group as the safer option in this kind of chaotic market that we're in with rising interest rates. We want to make sure that people have enough equity in their property to be on the safe side.
You also want to make sure that your debt cover is at least like a 120. And a lot of times if you go all the way to max, like to 75 or an 80% loan to value, then your debt cover isn't high enough. And then if you have a hiccup, then you're going to be a little short of cash, and nobody wants to see that.
No,
for sure.
definitely not. So I ran this model.
I think I've got your replacement property coming up in the next scenario, actually.
Yeah, yeah, I ran this model using those features, and I wanted to show it at a break-even cash flow because that would be like the bare minimum of what we'd be willing to accept. So again, just modeling purposes, this wouldn't, be exactly what this individual investor is probably going to go out. I would imagine she'd probably find something, a little bit lower in value, just to kind of be a little bit more on the safe side.
But also from just like a high level, like conceptual stuff, like we often just model like the straight numbers.
Yeah.
Like it usually means we're going to buy a $1 million single family residence.
Right.
But hey, it's $1 million worth of rental.
Could be
properties.
a triplex or a
Yeah.
duplex.
Yeah.
And multiple units.
Yep. Exactly.
So just stay focused on like the numbers and not what type of property is that exactly.
Exactly.
Right.
Yep. So if you were to find this, nebulous property, which is, very easily attainable in the Denver market, gets you to about a 5.2 cap. And and which is also very attainable in this market.
Yep.
So just wanted to show that, again, with a 7% interest rate, 35% down, we're looking at about a break-even cash flow. So what does that get this investor towards her goal? So kind of over on the right side, we modeled out the difference between her current rental property and then her 1031 of that rental property and the differences. So the key differences on this is that she's able to get about $440,000 more in valuation, in rental property valuation, which again, her goal was $2 million. And her NOI goes up quite a bit
Doubles.
as well. Yeah, it's pretty significant. So even though she was cash flowing better, technically, I think she was attaining $2,000 a year with the original rental property. She's just, relevering up. So it's just kind of getting absorbed in the interest costs a little bit more in terms of cash flow. So that was phase one of meeting this investor's goals.
And I want to, highlight here. This actually, I might have you rant if you can for a minute, Lon, about that cash on cash return.
Mm-hmm.
We were prepping for the slides this morning, and hey, the current cash on cash returns, 3.5. Doing this basically break even property, cash on cash is 0.2. So if that metric goes down, but other metrics go up, and you were saying cash on cash is probably your least favorite metric.
It's just my pet peeve. It's my least favorite metric. So the cash on cash, as we show it here, is the net operating income minus the mortgage to get the free cash flow divided by whatever the initial investment was. So I mean, that is one useful way to look at it. But I think a better metric is to take a look at that cash flow divided by what's the equity I have in the property today. Because when they initially bought this property, maybe you could rewind a slide or two. Do we know what their initial down payment was when they bought this?
I think it was about 50
grand.
Yeah.
Yeah. So, and now they've got 400, right? So this is like incredible that we've taken 50 grand and turned it into 400,000 in the space of 6 years or something.
Mm-hmm.
That's like nothing short of a miracle financially, right? But now we've got this huge war chest, and we want to make sure we're deploying it well. And that's why looking at the initial cash investment, I think it makes it misleading that I still have a great choice here by leaving the money locked up in the vault. And usually that's not the case.
Absolutely.
Yeah. And I would add to that basically, when you re-lever and you have a low current cash flow, it technically, you can see it as adding to your future cash flow. Cause like you see that NOI almost doubled, right? So over time, that NOI ends up becoming part of your actual cash flow because rents go up, et cetera. You're paying down the debt, et cetera. So it's kind of like a trade-off between now or in the future, I think, in cash flow perspective.
Yeah, I think that's it. I mean, usually people are either in a growth phase where they're just trying to get their portfolio to the size they want to be at, or once they're at the right size, then it's usually more of a cash flow optimization exercise. But it sounds like she's pretty clearly still in the growth cycle. So
Yes.
This looks like a great move to get her closer.
Got a question here from Jorge. He says, part of me is wondering if you're budgeting for expenses like repairs and maintenance with those break-even cash flow numbers.
Yes. So what we did here is with this modeling option within Property Llama, it focuses on when you input your modeling scenario, you put in your interest rate and you put in your cap rate. And from that, it just calculates everything else. So to get a cap rate of 5.2, we're just looking at our NOI divided by the value of the property. So it's kind of condensing everything into that, but it is based on a realistic market scenario of a 5.2 cap. So yes, but not detailed would be the answer for
it's
that.
Basically got, from a high level, it's got the 8% of gross
Yes.
rents for reserves and maintenance in there.
Exactly.
So yeah, we have
It's
a good
baked
rule of
in.
thumb factored in
Yeah. Mm-hmm.
Would it be fair just to kind of recap this? That it's probably like 5% for vacancy, 8% for maintenance, 8% for property management. So we're taking 23% right off the top of those rents, plus then all of our direct costs of insurance, taxes, and HOA if applicable.
Correct.
Okay.
Yep.
Correct. Yeah.
Yeah.
So it's a full realistic underwriting.
Yeah,
Yes.
that would be over a long period, probably just about exactly where you'll land.
Mm-hmm.
Perfect.
So option number 2 for this investor is that she also has about $300,000 in equity in her primary residence. So what happens if she taps into it? Caveat here, again, this is simply just to display her options. I'm not recommending that she leverage her primary to the hilt. That is very scary to me, but I just wanted to show it in terms of like absolute value. So obviously she would pare down based on, risk and being conservative in that approach, but just taking it from an absolute, opportunity right here. 100% CLTV HELOC. She has about $300,000. Again, 35% down, 5 cap gives her about $850,000 in purchasing power. So to kind of summarize that, between the 1031, which could give her about a $1.05 million property, and then a max HELOC, which again, she's not going to actually do, but it could give her the opportunity to buy an $850,000 property. She's 95% of the way to her $2 million assets under management goal in 2 moves.
Yep. That's awesome.
Yeah.
I think that also when you go to the HELOC, like even if she's not going to use it, she should probably get it, right? Because it's always better to get a loan when you don't need one than when
Right.
you do. And especially if she's going to take that other property to, maybe it's not negative, but it's not, maybe you mentioned even breaking even. What a great tool to have as a piggy bank to reach into if you had a challenge with that property.
Mm-hmm.
Or you might just come across an unbelievable off-market opportunity,
sure.
and then you're ready to like write an offer on it that day and
Yeah.
not let it get away.
Yeah. So, yeah, I think that's what I like so much about this Property Llama simulation.
That's great.
Feature is that you can see what it will do for you in just a couple of clicks, just to model it out. And then if that's the path that you want to go, you can actually sit down and get a more detailed strategy going. So, team, what do you think that the investor should do?
Oh, for the refinance or sale on the smaller investment property, the model that you had there, that seems like a layup. I don't know
like
why
a
you wouldn't do
no-brainer,
that.
Sure. Yeah.
Yeah.
And even if it's into multiple units, like we said, whether it's a duplex or 2 condos or townhomes or however it shakes out,
Yeah.
to achieve a little bit more cash flow and then work towards the goal of 2 million. Any idea why that number of 2 million sticks out for this investor?
I actually don't. I did not have.
So I actually talked to her on the phone.
Okay.
Didn't give the whole lot of reasons as to where that number came from, but that's what she wanted to work towards
Sure.
and make that like at least the next milestone, achieve that, reevaluate, and then go on from there.
Okay, cool.
Got it. Do you know, has that investor kind of back solved for how much money they'll need in retirement and how many rental properties that equates to?
I don't know. We did not discuss that.
Okay.
But actually, because I did a portfolio analysis session, I think just 2 weeks ago, and the plan that we left off with, I guess, which going to evolve, is pull out about $300,000 in equity from the properties, consider selling the other rental to see what it looks like. But easiest thing, put a HELOC on the primary, pull out $300,000, and kind of the rough plan was put 100K into like an NDF fund with Ironton, take 100K, go down to Pueblo, look for a rental down there, Jenny, and take the other 100K and just kind of sit for a bit and buy a Pueblo rental, buy an NDF fund, $700,000. I say buy those 2 things, sit out for a couple months, then deploy the rest. And then while doing that, figure out what to do with the other rental. If you like the rental market, then sell and do 1031. So that was the plan we left with 2 weeks ago.
So
That
we
sounds great.
kind of came up with similar conclusions for that. Yeah.
And that's what she's going
Yep.
forward towards it, and talking to a couple lenders right now.
Great.
Yeah.
Excellent.
Yeah.
That was a great analysis.
And we got some people asking, where do we have the lenders doing the HELOCs? Yeah, there's a bunch out there.
Just email us or call me, and I'll match you up with a few depending on your situation, because each lender's good at different things. So I won't waste your time with guys who won't be a good match.
Yep, exactly. Reach out to us, and it's always a constant Rolodex. So let's move into, while we're getting ready for the second pivot, which is Lon's here. I'm gonna hand you the keyboard, Lon.
Thanks,
I'll
sir.
answer a couple questions. Yeah, see a bunch of questions on lenders. Yeah, reach out to us. We got a great Rolodex here. Seth says, what is the charge for individual analysis? So we're doing like a free 30-minute portfolio analysis session with everyone. The goal being to give you a lot of direction, that 30 minutes as to what you need to do. If you need more one-on-one help, we will be charging some type of like consulting fee on that.
It's pretty nominal in the grand
Yeah.
scheme of things, though.
Yeah, or if you end up investing with us, we're happy to kind of keep doing that. But one way or the other, we just got to make sure we get compensated. But first thing is first, we'll do a free 30-minute session with you, help give you the big picture, and then figure out a rough game plan, see if it makes sense, you need more help from us, or who you should talk to. Cool. Why don't we jump into yours, Long? Because I know you built a new spreadsheet here.
We did.
And I'm excited to see it.
Happy to do it. So here's our team at Ironton Capital. So just a couple of comments for you. Our assumption is that we're going to see these high rates that we have right now for mortgages decline once we get into the recession. So this chart just shows you 50 years of history on mortgages. The gray bars show you the last 6 recessions that we've encountered, and you can see that mortgage rates dropped every single time. And if you look at it, it's likely we'll see a 1% to maybe a 1.5% drop in mortgage rates once we get into this recession. So just as you're kind of planning forward, that might be a really good thing to keep in mind. So for Jenny, for your person, that property that she buys, even though that mortgage might be at 7 now, a year and a half from now, she could refinance at say 5.5, 5.75. And I would just make that part of the game plan. If she's seen some appreciation in the interim, she might be able to take some of those chips off the table as well. And then that might be the next phase of your plan. Okay, so it's a frustration to find a good cash flow property, but it's not impossible. So this is a duplex in suburban Denver. Actually, when you were talking about your client, Jenny, this might be the one to go look at. This is a 5.9 cap, actually.
Wow.
It's on the market. So it's a 3-bedroom, 3-bath that's been pretty well renovated. There's a 2-bedroom, 1-bath that's occupied. I didn't get to see that, but the listing agent told me that it's in pretty good shape. It's got a 2-car garage and it's on a giant yard. So at a 5.9 cap, which is pretty attractive, if you do 75% loan to value, let's say you borrow at 6.9%, that's what the rate was when I put this slide together. At 75% loan to value, this is 100% DCR. So what debt cover ratio means, if you take the income from the rents minus your vacancy and expenses, you get to some sort of net operating income. And if you back out your mortgage, that's the free cash flow. What we'd like to see is that the net operating income is about 20% or 25% bigger than the mortgage. And that gives us a cushion. And that's called the debt cover ratio. So anything over 120 is what I would personally feel comfortable with. So this one at 75% loan to value, that looks a little too aggressive to me. But if you've got a client that's got a really strong W-2 job and they've got plenty of cash reserves, then they may not feel bad about kind of pushing it to the red line. That's what it looks like. If on the other hand, you want someone to be a little bit more cautious, I would say maybe a 60% loan to value. That gets you a 125 debt cover. So it needs a little bigger down payment. But then you've got that cash buffer there that if you have like an unusually large month for renovation or something, you're going to have no problems with it. So I ran it both ways, just depending on your investor preferences on like how aggressive you want to be with your leverage. For all the rest of this, we assumed 4% annual appreciation. So the last 50 years in Denver, we've ranged between 6 to 6.5% appreciation. So I wanted to be a little conservative on the appreciation estimate. I assumed that both rent and OPEX inflation over the next 5 years would be 3% a year. It really doesn't matter very much what you pick for your inflation rate, because if the rents are going to go up high, your OPEX are going to go up at a high rate as well. It's not like you're going to get high inflation and low OPEX. It's inflation that just wouldn't be realistic. And I assumed a 5-year holding period. So here's the as is look at this thing. If I bought this today with 40% down, so the purchase price on this would probably be in the $680 range. We got about $4,800 a month in rents. One of those rents is currently placed, the other is vacant. So I just went to Rentometer, picked the median value for that neighborhood. It's about a 2.9 cash on cash return. It's a 5.9 cap, which is actually pretty attractive for this particular market. So you'd need $270,000 as your down payment, something like that. So this is a 14% return on equity over that 5-year life. What if I had bought this back in 2016? So I would have bought it for say $450, and now it's worth nearly $700. So I've created $250,000 worth of equity, sort of like your client has. And when I bought that, I might have gotten like a 4% loan for 30 years. So like this thing is a cash flow monster, right? I'm running at like an 18% cash on cash return. So just remember though, that's the today's cash flow divided by my initial investment, which wasn't very high. If you take a look on there, just drop a little bit, you can see 5.5% would be my cash on cash return on today's equity. Actually, I should call it cash on equity return is probably the more proper term for that.
Is
Still
that like
not
a real?
bad.
Is that like a real official term in real? Because we've talked about it, but I've never actually seen
I've never seen
used.
anybody actually use it because nobody
Yeah.
thinks about it this way. They always think about their initial investment, which I think is really misleading.
Yeah, for sure.
Because this property has got like a ton of equity in it, so we want to think about, could we redeploy it in a new sort of a way?
Yeah.
So we put together a new Excel sheet after our last webinar last week because I thought this would be a lot easier to look at and understand. And it takes into account if I have an existing property with an existing loan more accurately than the shortcuts we did on the last one. So we're buying this for just under $700,000. You've got your rents in there, and you can see that our cap rate is a 5.9%. We've got other webinars where we talk about the analysis of a rental property in a lot of detail, so I'm not going to go through this analysis a lot today. I want to talk about what the analysis is telling us, not how to do the analysis. Does that make sense?
Mm-hmm. Mm-hmm.
Okay, so what you find here is that with 40% down, this is going to generate about a 3% cash on cash return if I'm purchasing it today. And it's about a 13 point. If you look in the pink at the bottom of the pink, it's a 13.5 internal rate of return. So that's the number I want you to kind of all keep in mind. My down payment wealth is growing at a compounded rate of 13.5% a year, every year for 5 years in a row with the analysis that we're doing. So the next best alternative, if I've got this cash, is I could put it in our National Diversified Fund 6, which is a passive investment. And our target for that is between a 14 and 20% return. We're thinking it's going to be in the 17% range. So the passive investment is actually a little higher return than this active investment is. And this duplex is the best of I looked at a lot of them. That was like the best alternative I could find in Denver Metro. You might be able to find something a little better in Pueblo or Colorado Springs, and that's what you guys do all day. So what I wanted to take a look at is, I'll tell you what, let's just finish this line off first. So if you take a look at the left-hand side of this chart, what I did is a 10-year wealth analysis of if I started with 273 grand of cash, I could either use that to make my 40% down payment on this duplex, or I could buy 273,000 of our passive investment fund. What kind of cash would I have available after 10 years? And the answer is that on the extreme left, you see that the investment in the duplex has grown to be about $950,000. So it's almost quadrupled. And the investment in our passive fund will grow to 1.35 million. So it's a little bit better than quintupled. So there's a $400,000 advantage to investing in the fund over a 10-year horizon versus buying the duplex where you've actually got to manage it. So that's the analysis I wanted to kind of compare, that you've got several options to think about. Does that make sense? Any questions on that? I'll kind of pause there.
Kind of curious from I've seen this analysis before. Travis, Jenny, Aaron. We also, I think we got a bunch of people in the chat too, and it's dense numbers, dense material, so it takes a little bit to digest. But yeah, ask some questions on here.
Yeah, I mean, well, as I'm looking at them, thinking, well, where's your tax advantages in the real estate? Of course, this is all pre-tax because you have to go apples to apples. In the fund, you would pay taxes on the income through distribution yearly, or not until you took the full bit?
So the way and we've got a different webinar on the fund where we go
Sure.
through a lot of detail, but I want to give you at least a quick answer is the growth fund is oriented to have as little ordinary income as possible and deliver as much in terms of capital gains. But what we can do is that we're not a REIT. So like a real estate investment trust, you're not allowed to distribute depreciation. We're a private equity fund, so we are allowed to distribute depreciation.
Okay.
So we do a cost segregation study to try to accelerate the depreciation as
Sure.
much as we can. So in the first year, you're going to get a dollop of a tax write-off in the first year.
Yeah.
So the bad news, of course, you have to give that back when you sell the asset
Sure.
in the end. But if you sell, when we sell and give you the big distribution at the end, if you take the proceeds and buy the next fund,
Yep.
you'll hopefully get a large accelerated depreciation. Then it'll mostly offset. So it's not like a 1031 exactly,
Right.
but it gives you almost the exact
Yeah, that
same
makes
impact.
sense.
So there's a lot of tax management we can do. And I think we're
Sure.
going to do a class on depreciation soon, aren't we?
Yeah, that's actually one of the bonus ones. I think it's December 6th.
Yep.
So 2 Tuesdays from now.
Yeah.
So that's when we actually do a depreciation, talking about like actually how to do cost segregation studies on direct and active rentals to maximize that, and also at the fund level to get a picture of like both of those, because they're both very, very powerful ways to maximize depreciation.
Yeah.
That's interesting. Yeah.
When you hear these scandalous newspaper headlines about this billionaire lady who paid almost nothing in taxes legally last year, the way they do that is usually depreciation. So we can teach you how to do that too. You don't have to be a billionaire to do this.
So we got some questions on here. So Christy says, have you run anything that is a combo so you can diversify risk? I'm assuming a combination like one rental and one fund, I think is what she said there. But
yeah, I'm going to show you that in just a second here. So you're leading the witness.
all right, so stand by, Christy. Mark says or asks, can you achieve that 17% return in NDF with $273,000, or do you need the $500,000 investment?
So the minimum investment in our National Diversified Fund is $50,000.
Yeah. So those numbers are regardless of the investment on there, Mark. It's 17% when it's 50,000, 273, 500,000. So in this model, he just used 273 from the equity on the duplex.
Yep.
Right. Yeah.
Yeah, I wanted to have it be an apples to apples comparison all the way across.
And then Christopher asked, does the return on the NDF fund include taxes, asset under management fees, other fees, etc.?
So it's a pre-tax number, but all the rest of the fees are included. So it's after all of our expenses, but it's pre-tax. And it's also similar if you take a look, if I just bought the duplex and I get that $950,000 return, that's also a pre-tax figure. So if you'd have, of course, some tax liability each year from the cash flows you generated. Early years, you'd actually have some tax benefits from the depreciation that you'd have. So I could do an after-tax one, and we could make this really complicated, but this made all the points that you needed for the initial, I think, objective.
A couple other questions on here.
Got an engaged audience there.
Yes, and let me switch to the close one so I can read better. I'm sorry, guys.
Get you
Jake
some reading
says,
glasses.
how are you investing the money from the fund? And so I know there's a couple detailed questions here. So Lon, you can give a very quick overview of some of these. And on, I think, December 5th, I'm getting the confirmation right now. We're doing a webinar that does a much deeper dive into it. So give a high level, and then I'll put the link in there for a much more detailed in a couple weeks.
So a quick answer is we did a 1-hour webinar on what's in the National Diversified Fund, but the quick answer is we, for Fund 5, which we just finished raising, we raised a little over 10 million. We'll make about 12 investments, about $1 million each. Half of the investments are new construction of apartments. The other half are heavy renovation of existing properties. About 2/3 of it is multifamily. The rest is industrial, hotel, self-storage, things like that. And then they're geographically diversified across 7 or 8 different states. So it's all real estate related, and a lot of it generates depreciation if you need tax write-offs.
So other questions on here. Peter says that 273 would have a hit for taxes not used compared to a 1031.
I'm sorry, say that one more time.
So that 273 number on here, he was saying the 273 in the fund would have a tax hit, but buying a rental would not because of 1031.
So the first scenario we just went through is assuming that you just have like 270 grand in your cash. You don't own anything, and you're trying to decide, should I buy a rental property today or should I invest in the fund? So the scenario I'm going to do next is I already own a property. I've got to decide what to do about it. Sort of like what Jenny just did. So I'm going to do that one next.
Great.
Good questions.
So there's some detailed questions about how the fee structure works. Come to the webinar, or I think Ben put an email into Nick at Ironton Capital. Come to the webinar, or email Nick or me or Lon, and we get you those details.
Yeah, or we can give you the webinar and help you out with that.
Yep. Yeah, I think that's all the questions.
Okay, great. So let's go through the other scenario. So that's fun. So I'm going to pretend I already own the duplex. So it's the same duplex. We just talked about it, but I bought it in 2016. I'm not going to buy it today. I've already owned this thing for 6 years. So it's worth about $700,000 now. I bought it for $450,000. So I've got a lot of equity in this thing. So if you take a look at my loan balance, it's it's something like in the $300,000 range. So what I did here is I just did the math for you, saying if I just kept it with the great loan I've got right now, it's like a 4% loan. I don't take out any cash. I just let the thing run for the next 5 years. What internal rate of return could I generate? And the answer is about 14%. It's a pretty strong return. So the stock market, by reference, over the last 50 years is right about at 10%. So this is going to outperform the stock market by a decent amount. So do nothing is certainly an acceptable answer. Another possibility is we could refinance this by getting a HELOC. And we might just go to 80% loan to value. We wouldn't want to take out all the possible cash. So we could take the cash that we get, pull it out. So the existing investment is going to have less of a return than it did before. It drops down to about 12.9. So it goes from 13.9 to 12. Whoops, shoot. Where'd I go here? So it goes from 13.9 to about 12.9, because when we take out that extra debt, it diminishes our returns, right? So the cash that we take out, we could invest that about $250,000 in the National Diversified Fund, where we'll make about 17%. The blended return ends up being higher. Nearly 18 is where we wind up on that. So that's one option. That's probably the most painless, because we're keeping the existing asset. We're keeping our existing great mortgage. We're just taking out a HELOC to scrape out some of the equity. So it's not debt equity. We're now actually just like really deploying it at a great rate.
So I go back to that. How is that the blended higher? I'm not following that math there.
You know, Vital built this chart for me, and I haven't gone through it in detail yet myself, and it'd probably take me 5 minutes to explain it. So I'm assuming Vital got it right.
Okay.
But that's a great question. I'm going to ask him that actually myself. So the other option is we could choose to sell this duplex today and then either buy something new, or we could just take all the proceeds and drop it into the National Diversified Fund. So if we did that, we'd sell today for just about 700. We'd have some transaction costs. We'd have some capital gains. We'd pay off the mortgage. We'd walk away with, I think it says 297. My eyes aren't so great either at this distance. So that ends up being about a 10% return. So in this particular case, selling it outright doesn't make a lot of sense. You'd be better off to do a refinance or better off to hold on to it. That's not true in every scenario. So you always want to study it. I think the one that Jenny looked at, your cap rate was like a 2.9 or something like that, right?
Yeah.
So in that case, if the cap rate was really low, that happened because the appreciation was really high. The rents have gone up a little, but not as much. So in that scenario, like a sale, paying the gains will probably make more sense. In this case, it's like almost a 6 cap, which is really strong. It made more sense to hold on to it because it's one of those rare properties that the appreciation has been great. The rent appreciation has also been great. So holding on still makes sense. Does this make sense?
It makes sense to me. And actually, I'm really curious to ask this question because, you know, Jenny and I referenced that 4% cap rate is kind of like the threshold when it makes sense to refi and keep or sell. Low 4% cap rate makes a sell. I learned that from you from I think your 10 missed class 5 years ago. It's always stuck with me. And that rule of thumb's been great. And it still seems to make sense in the new environment we're in with higher interest rates. But I'm curious, I've not asked you yet. Has that rule of thumb of if a property's below a 4% cap rate, does that change at all with the higher interest rate environment?
It probably drifts up a little bit. I'd have to solve for that. Probably like a 4.5 or 5 would be your threshold now.
Okay.
But we just showed at a 5.9 cap rate, it makes more sense to hold the property than it does to sell and pay the gains.
Yeah.
So the other factor would be if I only had this property for 2 years, my capital gain burden would be a lot less. That might change our answer. Or for your friend, if she had owned that property for 12 years, the sale option may not make any sense because her gains tax would, of course, be quite a lot higher.
Mm-hmm.
So there's a couple of big variables that go into it. There's not a single rule of thumb, and that's why we're offering the 30-minute assessment, because your situation is going to be different than anybody else's. We want to give you a really customized answer.
Yeah. No, I think this is where it's always good to, we always have to talk to your team. We're talking taxes, always talk to your CPA. So always do that. If you need one, reach out to us. We can give you a couple recommendations. But this is where there's no one magic variable.
Right.
There's a couple of variables. It's like a recipe. You have to look at a few things and figure out what makes sense based on the property, the market conditions, and also your situation.
Right. You may also have situations where you've owned the property for a while and you're sort of burned out on being a landlord, and maybe making a little bit less, but having it be entirely a passive investment might be the right choice for your family. And if that's the case, sometimes a slightly lower amount of wealth accumulation could still be the right answer overall.
Yeah. There's the the profit to headache ratio.
Yes, exactly. So let's take a look. So the left-hand side of that chart there was, I just have the cash. I'm trying to decide if I should buy a rental or invest in passive. The right-hand side of that chart is, I own it already. What should I do? So the first option is do nothing. So my 270 grand of equity today, over 10 years will grow to about $1 million. Another option is,
I'm sorry. That was my fault.
That's all right. You're just teasing me there. The second option is the one in the middle of, I could keep the asset, refinance out, take that cash, invest it in the passive fund, and that grows from the 270 to about 1.5 million. So it's about a $500,000 advantage. Or I could sell my asset today, and that one is not as profitable. That grows it from like 270 to about 730 over a 10-year period. So in some situations, like if you're just done with the property, that may still be the right answer, but financially it wouldn't be the strongest. Does that make sense?
It makes sense. And before we move on to the next property there, Lon, there's a few questions about this 10-year time horizon.
Yeah.
Both for the rental and both for NDF. But a couple people said, is the NDF a 10-year investment, or can it be liquidated earlier?
It's about a 3 to 5 year. So I just assumed that after the first 5 years was up, we'd reinvest the proceeds and do another 5. And then for the duplex, I assumed that after the 5-year analysis period was done, that you would just hold on to it and do another 5. But if you're curious, like any of these holding periods, like you could say, well, what is it like after 4 years? So after 4 years, you can see that looking all the way on the left-hand side, NDF would have grown from 270 to 520. Your duplex, if you would have just let it ride, if you would have bought the duplex and run it for 4 years, it would grow from 270 to 450. So it's about a $70,000 advantage to the passive fund. What's interesting is it's a $70,000 advantage for passive after 4 years, and it's a $400,000 advantage after 10. So the compounding really makes a lot of difference in the final years of the project. But I put the whole chart there. So like for that, exactly that reason, no matter what scenario you wanted, you could look it up and do the math really easily.
And keep in mind, just to kind of really take a big step back to stay at the high level and conceptual level, it's 10 years to show the big picture where it could go. Now, of course, as we talked about, every time you put a new tenant or re-sign the lease in your property, you're rebuying that property for a year, whatever that term the lease is, or you're going to refinance it. Or if NDF Fund 5 is wrapping up at year 4, 5, or 6, you redeploy it, you always have to look at, hey, what are the current market conditions and what are the expected returns then? So it's always a constant reevaluation. And right now we're in year 1. When year 5 comes around, things will look different. So understand this is give you a big picture modeling, but always constantly be coming back and checking it. And that's why we want to create the Property Llama software as your dashboard. We're going to keep doing these more educational webinars, help give you these tools. Understand this is just for modeling, give you an idea where things are going, but always, always, always reevaluate.
Yeah, because I mean, you might buy this duplex and just absolutely hate it. Like it's just a lemon, you know? And so like the projections are completely irrelevant at that point.
Right.
So,
You just never know what's going to happen.
Exactly.
I think somebody asked how long have we been running the National Diversified Fund. So NDF 1 was in 2019. That was 8 investments. So we've sold 4 of the 8 already. And then 1's under contract, and then 3 needs more time. And we're running to about a 21% annualized return on the very first one.
A couple other questions on here. Seth says or asks, what are the tax implications in NDF versus owning? The rental will get depreciation. Is there something similar with the NDF stuff?
Yeah. So with the National Diversified Fund, we're allowed to take the depreciation of the apartment buildings or warehouses that we buy, and we could prorate it out to all the limited partners. So you'll get a share of the depreciation. So you can use that as a write-off exactly as if you owned the duplex yourself. So that's exactly the same project. We're a growth-oriented fund, not an income-oriented fund. So we try not to generate any ordinary income for as long as we possibly can. So hopefully you won't have any tax liability from that. Then at the tail end, our goal is to be able to sell the asset with a huge capital gain, because that's usually for most people the most tax advantaged way to do it. So it'll look actually very similar to what your rental duplex would look like, in that you'll have some depreciation in the early years as a write-off. Eventually it'll turn into small ordinary incomes, and then when you sell it, you'll have this giant gain should you not do a 1031 exchange. So there's a lot of commonality between the two.
Jeff's asked, might be a little too detailed for this, but do you have a model that incorporates an investment such as the Lowell Townhome Development Unit?
Let's talk about that offline. So I don't think most people would follow along on that.
Yeah.
I don't want to lose anybody. The answer is yes, I do have one, but
basically just take this model, put in a higher IRR, and you have to keep it deployed every couple of years.
Yeah, exactly.
But yeah, we'll talk offline with that.
For those of you guys who don't know, Lowell is a 10-unit new townhome project that we did a fundraise for. We raised about a little over $1.4 million for that, and that rate of return was like in the mid-20s. So yeah, the wealth really grows quickly at that rate.
Return, yeah.
So we'll take this last question. I'll move on to the second analysis you have there, Lon. Seth asks, can I do a 1031 with my portion of the NDF upon sale of the asset?
No, regrettably, by definition, the IRS rules on the 1031s prohibit any fund, ours or anybody else's. But synthetically, you can do the same thing. So when you get to if you invest in the passive fund at the end, you're going to have this big capital gain. So you take all the proceeds from that fund and you invest in our next passive fund, and you're going to have a big dollop of accelerated depreciation that year. That big passive depreciation you receive will be enough to offset most of your gain that you had from the one that you just sold. So it's just like a 1031 in that you're legally deferring the taxes. It's not going to be a perfect matchup, but it'll be relatively close.
Great
question.
Yeah, let's try to squeeze in that last example if we have time to.
Let's do it. All right, so this one is Robinwood. So there's a whole continuum of rental properties you could buy. So on one end, there's what we would generously call workforce housing, which has, maybe a little rougher clientele, but has a higher cash flow. And on the other end of the axis, you've got, nicer properties in nicer neighborhoods that won't cash flow nearly as well. So if maximizing your return is what you're after, Robinwood would be a place to do that. So I owned a couple places at Robinwood when I started paring down my active portfolio to put more into passive. It was like one of the first ones I sold. I wanted to get rid of my headaches, and Robinwood was at the top of my list. One of the other guys on the investment committee for our passive fund, Vital, owns, 20 properties out of Robinwood. So he runs the place now. He's the sheriff out there. So there's.
Do you own any out there, Travis?
Not in Robinwood. I missed that boat.
I'm
I'm on the First
club,
Creek
huh?
boat.
Yeah, this is a similar clientele.
Yeah.
So there's a Robinwood that's on the market right now for $245. So that was the example I used. So both the duplex I just ran through, that's an active one on the MLS. I'm not just making that up. You can go buy that this afternoon if you want to. And this Robinwood is also, as of yesterday, active on the market for $245. 3-bedroom, 2-bath, has its own laundry. It's got like a common area pool. This one's been lightly renovated. You can kind of see on the photos like it's it's an original looking kitchen, but it's got new counters and decent looking appliances and new carpet. And it's ready for move in. It's a 5.9 cap. That was the best I could find among this type of clientele. So if you do 75% loan to value, that's probably like the max you could push for. Again, this is going to be right about 100 debt cover ratio. That'd be a little too thin for me, but it'd be okay for some people. That works out to a 16% IRR, which is very strong for this market. So the headache to return ratio, if the return's higher, the headache's going to be higher. Or you could be a little more conservative. Maybe you put down a 40% down payment. That gets you to like a 125 debt cover and about a 13.4, 13.5 IRR. And I had the exact same assumptions as the duplex.
Can you go back? I want to highlight one thing there, because again, this is a concept I've noticed takes a lot of investors a while to understand. You notice how the 75% LTV, lower down payment, more leverage will give you less cash flow, but a higher return.
Yep.
And conversely, the higher down payment will give you more cash flow, but a lower return because you're less leverage. So that's often the trade-off in real estate. One's not right or wrong, but it's a very important concept to understand so you can pick the right, down payment and investment strategy for you.
So that, the last time I talked to, one of our lenders, they have a 15% down product for, and you probably do too, right?
We only have DSCR, so we can do 20% down, but the 15% from the Fannie is, as an investor, is a great product.
Yeah. So there's a 15% down non-owner occupied product. So that comes with mortgage insurance and a higher rate. But if I were to do the math for it, even at the higher rate that the 15% down would require, I can assure you it would be a higher IRR. But the debt cover would look, be like an 80% or something like that. So you'd have to subsidize it a little bit every month, which some people wouldn't want to do. Okay. So if I just have cash and I'm thinking I could buy something at Robinwood, or I could, make a passive investment, what do those trade-offs look like? So this was the scenario where we're going to get a 30-year fixed loan, 6.9%. Odds are we're going to refinance that in 18 months at 5.5 or something. But for today, that's what I'm going to do with 40% down. And you can see that it's a 5.9 cap. It's a 3% cash on cash. That's actually pretty solid for this market. That was the best one I could find, at least at the moment, among the actives in the MLS. Well, what if I had bought this back in 2016? So I know that Vital, one of the guys on our investment committee, bought several. So I asked him, what was that like for you? So he bought one at 145. He's got a 4% loan on that. So he's running like a 21% cash on initial cash investment for that. So really high returns. But if you take a look at the cash flow on this compared to the massive equity position he's built up, 150 grand, it's like a 5.5% cash on cash, which is actually still pretty strong. Nothing wrong with that. This was a very strong investment. Actually, just like Jenny's client, knocking it out of the ballpark with that one that she had. So I popped it into the spreadsheet. And if you decide just to run this thing for the next 5 years and don't change a thing, it's about a 15.5% rate of return. I'm sorry, this is if you're buying it today. Sorry, this is my first time doing this presentation. I'm not as polished as I could be. So if I bought this today on the market, I'm at a 15.5 return. You look on the left-hand side, my choices are buy this thing at Robinhood and I get to manage it. My $100,000 investment is going to grow to about 420,000 over 10 years, 4x, pretty solid. Or I could invest in the passive fund, 100 grand grows to 497. It's a 5x return. They're both fantastic. I think it's a slight advantage maybe to the passive one, so I don't have to deal with the tenants at Robinhood. But you may have a different decision process on that. Does that make sense so far?
Yes, it makes sense.
Okay, so let's go to say I own this thing today. Let's see if we got on the right page here. But what if I already own this thing and I've got this great cash flowing asset? If I run it as it is for the next 5 years, it's going to work out to about a 13% IRR. So that's one option. The next option is I could try to do a refinance and take, so I've got a 4% mortgage, right? I don't want to get rid of that. I'm just going to take a HELOC on this, and I think I'm going to pull out 100 grand. Or I could sell the thing. And that ends up being a 13.5 rate of return. So I could tell you that's not going to be the winner in this particular scenario. So if you look on the left-hand side of that Excel sheet, our options are 13.5 if we keep it and run it as it is. If we get the refinance and then we put some money in the passive fund, it works out to 18.7. So that's the blended rate. Someone asked about that earlier. So this is the blended rate, a little bit of both. And then the last is I sell the thing outright. I'm just sick of dealing with the tenants there, and I get 13.4, which is actually very similar to just to keep it as it is. So there's not a big penalty in this case for paying the thing off and paying the capital gains. And you can see that there's about a $200,000 wealth accumulation advantage to doing the refinance and getting the passive with the proceeds from that.
And is the reason for that because technically with that middle option, you are max leveraging essentially in one form or another?
You're going to max leverage. So I assume the HELOC would be at about 7%. And we're investing at 17. So this is basically what a bank does, right? Bank has a savings account. They pay you 2% interest and they're lending it out at 7. So they're making 5 points of spread. In our case, we're borrowing on a HELOC at 7 and we're borrowing it out to us at 17. And you're making 10 points of spread. So you're doing like double what a bank can do. So that's why that you're at like the 18% blended return is that leverage factor.
So in the middle option, I guess maybe your biggest downside is servicing the debt on the HELOC through the term of the 10 years or 5 years until you get your payback.
Exactly. Yeah. So let's go back and take a look at that actually. So if I do the refi, did I put the debt cover on here? I did. If you take a look at the blue box and immediately below the blue box, you see where it says combined debt cover ratio. With that $100,000 HELOC, I'm now running at 110 for my debt cover. So I've got enough cash to pay all of my expenses, set aside 8% for my maintenance reserve, set aside 5% for a vacancy loss reserve, pay my mortgage, and I still have 10% left over. Okay. So if something catastrophic happens, at least I've got some additional accumulation. So I didn't want to cut it too tight on this. I didn't want to go all the way to 100%. To me, that's too aggressive.
Sure.
If you go back one slide, so the debt cover on this is like, I've already owned the asset. I've got this 4% mortgage from 6 years ago, and I haven't refinanced it ever. I'm running at a 234 debt cover. So I've got like oodles of cash coming out of this thing, right? So I'm going to go from that to this.
Right.
And the trade-off then is I get 100 grand of cash today, tax-free, to go put in this passive fund. Great question. I'm glad that you brought that up.
So I got a bunch of questions to throw your way.
Yeah, so
you ready?
I'm ready.
All right. So no particular order. Jeff asked, why do a HELOC versus a cash out refi? Isn't it a lower interest rate with a cash out refi?
So I asked the lender this, and it is a little cheaper to do the cash out refi, but not a lot. And if you do the math, losing that great 4% mortgage you've already got in place on this existing asset, the HELOC is the winner at the moment with this interest environment. A year from now, if the mortgage rates drop to say 5.5, it may be an entirely different answer. The other thing, and I forgot to mention this, like if you do this HELOC right now, you're going to be like at a 110 debt cover. That's fine, but it's like a little tight. If in a year and a half you can refinance that HELOC from 7 down to 5.5, your debt cover is going to go up a bunch.
That's a good point. I never thought about that.
This isn't going to be for forever. This is like 12 or 18 months. You're going to be tight, and then you're going to be fine.
Mark says, what does your cash flow look like for the middle option?
Oh, let's take a look at that. So,
and I think I want to make sure which middle option. I want to make sure. I think I know which.
So the middle option, I think he's talking about that one right there.
Right here,
so that's my
today,
refinance.
You do a refi and passive invest. We'll assume. Yep. Mark says yes.
So that's this one. So my cash flow in year one is $14,600. My old mortgage, which is a low balance at that 4%, my debt service is $6,000 and change. I've got this HELOC that's got, I think the payment on that is $7,000. So I don't know why there's a second line in there. I've got to like check that out. Oh, you know what it is? I apologize. We should have done this in a more consistent way. The passive fund that we put in here took most of the cash up front and takes a little bit of cash 12 months later. So that's what that 8,000 negative is. Let's look at the second year. That's going to be much, I'm sorry to make this confusing. I could have done a better job on this. Second year, I've got cash from operations of 15,000. My first mortgage is 6,000. I've got, skip the NDF because they're giving cash back. We're going to disregard that. I've got a $7,000 payment on my HELOC. So 9,000 minus 7,000, I'd have $2,000 of cash flow. That's why the debt cover ratio is 116. The reality is you should have some cash coming back from that passive investment, probably about 12 grand. So your returns are actually going to be quite a bit better. But that's not the question. I don't think that's really what he was asking me. Did I explain that? I'm sorry that was confusing.
I think I was just curious, like, if you do the HELOC on this property with the new debt on there, what's the cash flow on the current property? It's really hard to define kind of what the cash flow is from the fund side, since that's,
we should take that out to make it simple. So the cash flow on the property is going to be the $15,000 minus the $6,200 of your mortgage payment on your first mortgage, minus the $7,000 on your HELOC is going to leave you about $2,000 of cash left over. And that's after vacancy, after property management, and after maintenance reserve. And
do you know, I'm kind of going back to the questionnaire, I think from Jeff on doing a HELOC versus a cash out refi.
Yep.
Another reason I like a HELOC versus a cash out refi is that most HELOCs are interest only for a couple years.
Yeah.
Some are like 5 or 10 years. So where cash out refi, it's principal and interest from payment one.
Mm-hmm.
So, if you just have a HELOC, your payment will actually be lower if you're just servicing.
Make your cash flow a little bit better.
Of course, you have to be financially responsible to, make sure you can pay it off in a couple of years, but a lot of times it actually helps with cash flow as well.
Yep, absolutely.
It also provides you some flexibility. Let's say these numbers are a little different, but you take 100 on the HELOC or 100 to invest in the fund. You still have 50 sitting there. You could go buy another property or make some improvements.
Right.
So the HELOC gives you that flexibility where the cash out, you're just paying on it from day one. And
yeah, I mean, I think a lot of people, like, let's say we got the HELOC for 150, but we only invest 100, we leave the other 50 there. If I do have a maintenance problem, I've got 50 grand to go take care of it, as opposed to under levering it. And then, I've got all this cash that's accumulated, but I'm not investing it well. For a lot of people, that actually probably would be the optimal answer. It just kind of depends. What makes you sleep well at night?
That's right.
And everyone's got a different answer. Or more, what makes your spouse sleep well at night?
So Mark asked a follow-up question. He said, I just want to know what you have to feed this in the first few years. So it looks like it's interest only. So Mark, if we have, $15,000 in NOI or cash flow, subtract out your $6,200 a year in the first position mortgage, and then basically subtract out the other $7,000 in servicing the HELOC.
You should have
$1,000.
You should have $1,300 left over. Yeah. You shouldn't have to feed it.
So hopefully the property should be able to pay for itself.
Yeah. So who asked that? Was that Mark who asked it?
Yeah. Mark and Jeff said they
great.
got it.
Yeah. So, I mean, what we could have done is we could have taken that HELOC up to like 150 and had more to invest in the passive fund, but then you probably would have had to subsidize like $500 a month. But that didn't seem appealing to me. So I didn't dial the leverage up that high.
So a couple other questions on here. So Seth asks, I'm confused on leverage. Isn't the tenant paying for any leverage? Why would someone be concerned at 100% debt coverage ratio?
So with 100% debt cover, I'll do the definition again. So if you take your rents minus your vacancy, minus your operating expense, and for us, operating expense is like your direct costs, tax, insurance, HOA, utilities if you're on the hook for that, but also an allowance for 8% for property management, 8% for your maintenance reserves. So we want to have those reserves in place to be pessimistic because you're going to need it eventually. That ends up at your net operating income. So if you didn't have a loan, that's the cash flow of the property. And then we've got our debt service below that. And then whatever's left over is your cash from operations, cash on cash. So you want your net operating income ideally to be a little bigger than your mortgage payment. So if you take your NOI divided by your mortgage payment, that's called your debt cover ratio. So I would generally target to be at 120%. That means my net operating income is 20% bigger than my debt service. What if it's at 100? It's exactly matched. It's not really that big of a deal. The only thing I'd worry about is it'd be my luck. I'd have a vacancy for 3 months and a bunch of maintenance stuff that all come up at the same time. And now I've got to subsidize the property. So if you are still in the earning years of your career and you've got plenty of great cash flow or you've got a HELOC in place with a $50,000 line on your HELOC you haven't used yet, or if you've got great cash reserves, any one of those things, like you're not going to have a problem. Like you just subsidize the property for 3 months, get the new tenant in, do the repairs you got to do, and you're off to the races again. If you're someone who doesn't have like a lot of extra cash from your job, or you don't have the cash reserves, or you don't have that HELOC as a security blanket, what I don't want you to do is to fall in a financially stressful situation like, well, shit, I got to pay my mortgage on my house and I got to subsidize this as well. And my wife is yelling at me. We don't want to put you in that situation. So
I can't get the rehab done because I don't have the money. I can't get it rented because I can't do the rehab.
Yeah. We want to set you up for success that any scenario the economy can throw at you, you'll be able to effortlessly handle it financially.
And the other thing, I can go back to like your first question or first part of that question is, isn't the tenant paying for any leverage? Well, yeah, your tenant's paying for that, but like I don't look at it. I don't think it's.
I don't think about it that way.
Because if I go to you, Travis, want to get a loan, you're looking at me, not my tenant's credit score.
Yeah, I'm on the hook.
Let's remember that regardless of cost of finance or amount of leverage, that doesn't change the market rent, right? So the income is set by the market. The leverage or your payments is set by your risk tolerance or what the market will offer you there. So not directly correlated.
Because who's on the hook?
Yeah.
Right.
Not my tenant.
Right.
I am.
Yeah.
Right.
The tenant leaves,
like let's
you have
look
to
at,
write
I
the
don't know,
mortgage
let's
check.
say halfway through 2020, who was on the hook? Well, it wasn't the tenant who wasn't making payments, right? Protected by the government. So let's remember, like, you got to have these reserves in order to operate your business for sure.
And I mean, your tenant's paying as good as the last rent check.
That's right.
And at that point, like the bank doesn't care if
they don't care
paying or not. They're like, hey, Jenny, you sold me that check by the 15th of the month.
Right.
So Seth has a follow-up question. He said, thanks. That makes sense. So it sounds like 100% debt coverage ratio is essentially banking on appreciation of the asset.
Well, yes. Yeah. If you're at 100% debt cover ratio, you're not generating any cash today. But it's important to realize that when you buy an investment property, you're generating wealth in 4 different ways, right? There's the cash on cash return, which is the one you're talking about. And that's the piece of the iceberg that's above the water that everybody focuses on, the cash on cash return. But the reality is the iceberg below the water is like way, way bigger than the little bit you see on top. So the second method of wealth generation is the appreciation. And for most people, that's the preponderance of the wealth that you generate. There's some depreciation tax benefits. Those are the hardest to understand, but they end up being very powerful over the long haul. And then your tenant is helping you to pay down the balance a little bit each month. So one of the really cool things about Property Llama, if you look at this little chart here on the right-hand side, current annual return breakdown. So you can see that appreciation is the blue bar. That's probably the biggest. And then the purple is I can't read what that says. Cash flow?
Cash flow.
Yeah. So this is the guy. He bought this in 2016. He's got a cheap mortgage, really low leverage. So his cash flow is really strong, right? And then there's a really tiny part in green that's probably depreciation. Then there's an orange part from maybe that's debt pay down or something like that.
That's depreciation.
Oh, depreciation.
Yeah,
Got it.
Yeah, appreciation's a blue, debt pay down's a yellow, purple's cash flow, depreciation is green.
So let's contrast that to this one. So this is I do have cash today, and I'm going to buy this today. at today's higher mortgage rates, I'm going to have a lot more leverage. So here you can see appreciation is a larger piece of the pie, and the cash on cash return is a much smaller piece of the pie.
I kind of see cash flow in the beginning years as your first layer of defense when things go wrong.
Right.
So, you know, how much can the cash flow float me from when such and such breaks, you know, each month or each year or whatever. It's not until several years in the case of your
This one here.
Yeah, the person that, you know, bought it in 2016 that you actually get to, you know, benefit from the cash flow.
Right.
So that's kind of how I look at it.
It takes a while.
Money
Yeah.
today for money later. There's few
Yeah.
investments that you can invest today and then reap, you know, 8, 10, 15%.
That's really rare.
Yeah.
Right.
Yeah.
Not numbers related, but I'm glad what stuck out to me when you said that, you said when something goes bad.
Yeah.
And that's the right thing.
Not if, when.
It's
Yeah.
always when.
Mhm.
In real estate, business, life, like that's it. So you said it right, but I want to just highlight that for people. Just, you know, hope for the best, but plan for the worst, and have some type of cash in the bank.
Yes.
Or HELOC to
Yeah.
help those situations as well.
Yeah. That's, I mean, kind of a tangent, but like cash flow is my first layer of defense. Cash in the bank is my second layer of defense. And then if, you know, everything goes to trash, I have equity in that property.
And
so,
I'll give you a real example. Or so a few minutes ago, Lon talked about, hey, if you do a 15% down load, you know, you'll be subsidizing, but still gives you a better return. It makes sense. I bought a property of 15% down loan last year for the exact reason. And guess what I did the last 2 months? I'm subsidizing the property. It's the front house with the back ADU, and tenants left. And then there was a little bit of a leak. So it took a month or two to fix up the mold, replace the carpet. And then it's an unincorporated Adams County, and the road in the back is almost impossible to drive through. Of course, you know, trying to get that repaired is incredibly difficult. So between some repair, now I'm at like 3 months of vacancy. It's exactly what you described.
Yep.
Now I've prepared for it. You know, I'm not excited about writing a $6,000 check in the bank account, but I'm like, I can handle it. I can do it. It did get rented out last week. Thank you, Eric Ross. But that's exactly what happens. Like you said, exactly what you said is exactly what happened to me in that scenario. And that's why you always plan for when things like that happen.
Right.
If you, you know, last week you guys were talking a little bit about the difference in rate on 15% down versus 20. If you do the break-even analysis on that, like you probably won't even own the property at that time, and or you'll be able to refinance at 5.5 or whatever rates might be next year. So I think that especially when you're growing, the least amount in with for leverage, of course, but more money in hand is way more valuable.
Oh yeah, absolutely.
Yep, I totally
agree with that.
So I know we're going over here, but we can spend a few minutes going over questions because these are just fantastic
Great questions. Yeah.
Someone or Seth says, do any of the panelists own property outright then? Is it just a peace of mind, or is it better financially to leverage over the long term 20 to 30 years?
I do.
You own
I
it
do.
outright? Yeah.
Yep.
I own multiple properties for clear.
So you Jenny and Travis, you guys, one of you talk a little about that.
I mean, I know from a spreadsheet, I do not get the absolute best return, but I've been fortunate over the last 10 years to generate a really strong income. And so my goal of getting to a certain cash flow one day is not driven by the top return from each property, but more of a cash flow number. And so that's what I've been working towards. I know 100% my return on equity is awful. I look at property law, I'm like, oh gosh, this isn't challenging.
but that's not your goal anymore.
Right. That's right. And so it's just a different approach that I took. And what drove that for me, just quickly, I was in a new construction project a couple years ago. We were $500,000 over budget. COVID hit. Like, it was really uncomfortable. You talk about those sleepless nights. Like, I was up a lot figuring out what was I willing to lose on this deal to keep going. Now everything worked out relatively, but I felt like at that time, I don't want to ever think about that again with 3 or 4 properties free and clear. Like, we probably don't have to work, but it's just this really strong security blanket.
Yeah, it's same. I mean, it's all emotional, I would say. We have 3 paid off properties, and that makes me sleep at night knowing that if, you know, this property is being a headache, I am more than compensated on these properties. Like, a lot would have to happen for me to be net zero in any given month. So yeah, it's 100% emotional. Like, I could definitely sell and trade up or relever or something and maximize and optimize that. But I don't know if I'd sleep very well.
But when I did pay some of them off, I got a line of credit so that now that I didn't have access to the cash, I have access to the money.
So sir, if you need it,
for sure.
If you found like a really great deal today, it was off market.
Yeah.
Hey, but you got to close quick. You'd be able to do it tomorrow afternoon.
Yeah, exactly.
I'm curious if you do, Lon, because I always introduce you, and I've learned a lot from over the years. I'm always like, Lon is Mr. Leverage and Mr. Like.
I have
make
never
that
had a
equity
paid
work.
off property.
So-
But I've got a higher risk tolerance than most people, and my wife just couldn't be less interested. So I don't have like a check and balance like most normal people would. I think our weighted average is like 60% or something like that.
like a 6% like global LTV.
Yeah, probably
Yeah.
in that
Okay.
range.
I think that's still pretty good. I
Yeah.
think that's conservative.
It's not too bad.
Yeah.
Yeah, I don't have any paid off properties. I think talking to people, I am on the higher risk tolerance side. But again, I keep a lot of cash in the bank because I'm like, well, as long as I can float payments for a year and take care of the worst case scenarios when the road can't be driven on for a couple months, I should be good.
Yeah.
But I'm very comfortable with that.
You've got a good way of looking at it. So for the guys on the webinar, we've got a different webinar that explains like how many properties do I need to retire. So we can help you back solve in that webinar. I won't do it now. Let's say you need 8 houses or whatever your number ends up being. You're going to be in an accumulation phase for about a decade trying to acquire those 8. And that's a real pain because coming up with 150,000 cash down to buy the next house, that takes a while, right? So you want to be more aggressive on your leverage. When you get to the right number, for many people, your strategy is going to be the exact right thing to do. How fast can I pay these things off? Right. So everyone's going to have like a different journey that they go through, but that's really typical what I hear.
Yeah. Great. Well, I know we're about 10 minutes over. I appreciate everyone staying on. This was a very
great
discussion.
discussion.
Really enjoyed it. So kind of taking a step back, definitely check out the recording on here to go through it. If you couldn't quite follow all the numbers and scenarios, don't get too caught up.
It's a lot.
That's why we want to do these one-on-one portfolio analyses. But that the takeaway concept here is it's about the more leverage you have and understand the power or the opportunity cost you have with equity locked in the property. If you want to really use your returns or increase your returns, tap in the equity. HELOC, second, sell, whatever, but making that equity work for you is the key concept there. And that's where we can help you figure out the best moves. But it's leverage and moving the equity is the key point. I'd say walk away from there.
Yep, exactly.
Panelists, any closing remarks or thoughts?
I'll leave the group with this. The entering the properties, depending on how many you have, can be a task in Property Llama. But I would suggest everyone does it. Like Property Llama 0.5, like when it was still in a spreadsheet, doing that the first time changed like my whole focus on my portfolio. I was just kind of getting lazy. I was under rented, but hey, I was still making money. I had an income that it didn't really matter whether the rent came in or not. Focusing on your business through the Property Llama and taking the 30-minute call will add so much value to somebody's goals and their long-term. So I know that was the primer, was to actually do the work, and then have the meeting for sure.
Thank you.
Yeah.
Aaron, I know you're remote and it's hard to jump in sometimes, man. Any closing thoughts or things that you want to leave us with?
Yeah, I would just say that there was some really great analysis today. And I think whether or not it's a HELOC, you're going active route, the passive route, these are all basically tools that you can utilize to help you get towards your real estate goal. And one of the key takeaways for me here is that understanding these tools and having the ability to make the proper assessment is all what Property Llama is for. It's a very powerful tool to utilize to take that global view and to help us make trade-offs between whether or not I want to go the active route, passive route, HELOC, 1031 exchange, etc. So hopefully most will be able to take advantage of the portfolio analysis sessions and utilize the Property Llama tool. And we would love to get you guys' feedback as well.
Awesome. Well, Aaron, Jenny, Travis, Lon, thank you as always. Always appreciate you guys taking your time out of your busy day. Attendees, thank you guys so much. We love this. Any follow-up questions after you hop off here or if you're catching the recording, do not hesitate to reach out. We love talking about this stuff, and that's what we're here to do. Have a great one, everyone. We'll see you
Thank
next
you.
Wednesday.
Thanks, Chris.
Appreciate it.